Hello everyone, welcome back to our channel and welcome back to the Capital Insight series. This video is going to be dedicated to the tokenization of traditional assets. Tokenized equities represent one of the most significant structural shifts emerging in the global capital markets. These digital tokens, which provide price exposure to traditional stocks via blockchain infrastructure, enable round-the-clock trading and near-instantaneous settlement. While currently prohibited for US retail investors, major institutional players including the DTCC and Nasdaq are building infrastructure for domestic adoption. The current global market stands at approximately 900 million with approximately 200,000 holders. But the trajectory points towards comprehensive tokenization of the traditional assets. DTCC has articulated an ambition to eventually tokenize the full 100 trillion in assets under its custody. For investors and allocators, understanding this infrastructure and evolution is essential to anticipating how the market access, settlement mechanics, and capital efficiency may transform over the coming years. Let's first start by defining the tokenized equities. Tokenized equities are digital representatives of stock exposure that exist on blockchain infrastructure. In their current predominant form, these tokens function as derivative contracts rather than actual equity ownership. Holders receive price exposure to underlying stocks but do not obtain the legal rights typically conferred to the shareholders, including dividend distributions and voting privileges on corporate actions. The primary operational advantage lies in settlement efficiency. Traditional equity settlement operates on T+2 basis, meaning transactions clear in 2 business days after the execution. Tokenized transactions settle in seconds. Additionally, these tokens trade continuously, eliminating the constraints of exchange operating hours. However, this round-the-clock availability does not guarantee continuous liquidity, as trading activity remains concentrated during the traditional US market hours when the underlying assets are actively traded. Next, let's try and understand the current market architecture. The global tokenized equity market currently encompasses approximately 900 million in circulating value across roughly 200,000 holders. This remains a fraction of the traditional equity market but represents meaningful infrastructure development. The key platforms facilitating this activity include the Ondo Global Markets, the Bungie Exchange, and the MEXC. Major crypto-native platforms including Robinhood Markets and Kraken have extended tokenized trading capabilities to their international customer bases, though the US investors remain excluded under the current regulatory frameworks. The user base skews heavily towards crypto-native investors and international participants seeking US equity exposure. A key utility driver is the ability to transact using stablecoins, eliminating the need to off-ramp from digital assets to fiat currency. For the investors holding substantial crypto positions, this preserves capital efficiency and in certain jurisdictions offers tax advantages by avoiding realization events that would be triggered by crypto to fiat conversion. Next, let's look at the trading dynamics and the liquidity constraints. Now, while the tokenized equities offer continued market access, effective trading remains constrained by liquidity concentration. Best execution, meaningful optimal price fills, and minimal slippage typically requires transacting during the US market hours when bulk of the trading activity occurs. Outside these windows, thin order books can result in meaningful price deviations from the underlying asset values. Importantly, during the recent periods of elevated market volatility, traders seeking 24/7 exposure have gravitated towards perpetual futures rather than tokenized equities. Perpetual contracts, which are derivative instruments without any expiration dates, have seen substantial volume growth on platforms like Hyperliquid. Oil-linked perpetuals on the exchange grew from 339 million in cumulative volume at the end of February to 22.5 billion by late March, illustrating the demand for continuous trading access during periods of geopolitical uncertainty. This suggests that while the tokenization infrastructure is developing, existing derivative instruments currently capture more trading activity for speculative and hedging purposes. Next, let's look at the institutional infrastructure development. The most consequential near-term development is the entry of major financial market infrastructure providers into tokenization. The Depository Trust and Clearing Corporation, which safeguards over 100 trillion in financial assets, has articulated plans to tokenize US Treasuries for which it serves as the custodian. Leadership has also characterized this not as speculative positioning but as a response to concrete client demand and business requirements. The stated long-term ambition encompasses the eventual tokenization of all assets under the DTCC custody. So when we are talking about the infrastructure, we have Nasdaq tokenized share pilot, which is SEC approved. We have the DTCC treasury tokenization, which is planned. We have the NYSE tokenization platform in development, and we have qualified US investor access, which is active but for select assets. As we just shared, Nasdaq has received the SEC approval for a pilot program enabling investors to trade select high-volume stocks either as traditional shares or as blockchain-settled tokens. Settlement would occur through DTCC, maintaining integration with existing market infrastructure. The New York Stock Exchange is similarly developing tokenization capabilities, and qualified US investors already have access to tokenized versions of certain asset classes, including money market funds, private funds, and commodities such as gold. So, what are the strategic implications for capital allocation out here? The tokenization of traditional assets carries several implications for investors as well as allocators. First, it expands the addressable investor base for the equity markets. Younger, crypto-native demographics who have not traditionally participated in stock markets gain a familiar on-ramp to digital asset infrastructure. Secondly, geographic barriers diminish as international investors gain more efficient access to US equities without navigating traditional brokerage relationships and currency conversion. However, the material limitations do persist. The absence of shareholder rights in the current tokenized structures may matter less for traders focused on price exposure but represents a meaningful gap for investors seeking governance, participation, or dividend income. Liquidity fragmentation remains a structural challenge, and the regulatory pathway for US retail participation is still developing. For the sophisticated allocators, the infrastructure built out at DTCC and major exchanges signal that tokenization is transitioning from experimental to operational, warranting attention to how settlement mechanics and market access may evolve. Now, that's what we wanted to share with you with respect to tokenization. This was an update video. Stay tuned in for our next one.